Welcome back everyone to the Audacious Money Witch channel where we talk about the magic behind the stock market. Something big is happening behind the scenes at Estée Lauder, and their latest warning should send shivers down your spine. This could be the tipping point for the global economy. This is not a coincidence. Estée Lauder's warning was just the tip of the iceberg. As you are about to see, what happens next could be devastating. It's not just Estée Lauder, it's Pepsi, Calvin Klein, tariffs, DeepSeek, Google Cloud sales miss, and huge risk is piling one after another. I'm going to tell you what I did later. Let's jump right into it.
Breaking news! Let's start with the shocking headline. Estée Lauder sinks nearly 20% on weak quarterly sales. Planning to slash up to 7,000 jobs, luxury beauty brand Estée Lauder announced a major restructuring plan as the company grappled with persistent demand weakness, sending its shares spiraling nearly 20%.
This is something that we've been warned about. Because workers are seeing their pay raises slow down, they're seeing their hours of work get cut. And unfortunately, some of them are even headed to the unemployment line. As the Manhattan-based company, founded and controlled by New York's Lauder family, said it will cut 10% of its workforce as part of the expanded turnaround plan under new CEO Stéphane de La Favière, who took over on January 1st. For household budgets, this is dangerous because inflationary price pressures are not abating as fast as the Federal Reserve claims that they would. What this means is we're seeing more and more people have to trade down. That means less money to spend on discretionary side of the economy.
The cosmetic giant now expects third quarter profit to come well below expectations, citing challenges in its Asian travel retail business, particularly at airports and travel destinations in Korea and China. For the third quarter, we expect overall soft retail trends to persist in Asia travel retail, significantly pressured our organic net sale, CEO said.
Estée Lauder, which owns brands like Clinique and MAC, said it will wait to release its full-year forecast because of evolving global geopolitical uncertainty. Estée Lauder brand has been hit hard for months, facing weak demand for high-end fragrance and makeup products, and stiff competition from rivals like L'Oreal. Sales were down 12% in its skincare business, its largest by revenue, and about 1% for its makeup division, its second largest top-line contributor due to challenges in the retail market in Asia. Hair care sales were down 8% from softness in the salon channel and the timing of shipments. Fragrance sales were up 1%, driven by their luxury brand like Tom Ford. On the bottom line, Estée took $861 million in goodwill asset impairments and more restructuring charges.
They started cutting jobs in 2023 to combat falling sales. They had initially expected to eliminate up to 3,000 jobs and employ 62,000 people as of last June. EL stock has fallen more than 50% over the past 12 months. It was the worst performance in the S&P 500 Tuesday, down 16%.
Simply said, we lost our agility. We did not capitalize on the higher growth opportunities. CEO said net sales are expected to drop between 10% to 12% next quarter, worse than the 6.8% fall predicted by analysts. Estée Lauder has faced challenges in boosting sales growth in China, which accounted 25% of the company's sales in 2024. Due to high unemployment, a struggling economy, and an increasing preference for local brands, China now boycotts American brands because of U.S. tariffs. Beijing has just added Calvin Klein owner PVH Corp and Illumina to its unreliable entity list, which leads to China's DeepSeek attack, looking at AMD stock selling off after double beats. I am pretty sure this is only the beginning of the DeepSeek pain that is priced in.
Estée Lauder lost $590 million this quarter, compared to a profit of $313 million the same quarter a year ago. Stripping out one-time items, adjusted earnings were 62 cents a share, still below 63 cents a share analysts had expected. Revenue fell 6% to $4 billion, beating analyst forecasts for $3.98 billion.
The 78-year-old cosmetics giant said it is expecting adjusted earnings per share to plunge as much as 79% in the current quarter compared to the year before. While we are not satisfied with our third quarter outlook, it primarily reflects weak retail sales trends in our Asia travel retail business, which deteriorated in our second quarter, driven by Korea. CEO said, for the third quarter, we expect overall soft retail trends to persist in Asia travel retail, significantly pressuring our organic net sales despite the improvement we made with in-trade inventory levels. CEO said his turnaround plan focuses on getting new, trendy cosmetics products to the consumer quicker and marketing them better.
CEO expects contract terminations and other costs involved in a restructuring will cost between $1.2 billion and $1.6 billion. The overhaul is expected to yield $800 million to $1 billion before taxes in annual benefits, which should help restore operating margins and reinvesting into their business.
Estée Lauder launched the restructuring in November 2023 with a goal of expanding margins in 2025 and 2026 by focusing on profitability, lower costs, and accelerating sales growth. The expanded plan is designed to further transform the company's operating model to fund a return to sales growth and restore a solid double-digit adjusted operating margin over the next few years, and continue to manage external volatility, such as potential tariff increases globally. Estée Lauder said the plan aims to expand Estée Lauder's presence in high-volume sales channels, such as Amazon.com, to diversify its growth and bring in new consumers. They also expect to reduce its reliance on travel retail.
We think there is a very long road ahead before the company can return to even market level organic sales growth and attractive operating margins. The changes in the organization structure strike us as not really resolving much in terms of clear line of accountability and ownership, said Lauren Lieberman, Barclays analyst.
You're about to see what's happening at Estée Lauder is spreading rapidly across the rest of the world, as PepsiCo's earnings topped Wall Street's estimates, but the company's revenue missed expectations. Demand for its snacks and drinks declined in North America. Pep shares have declined 12% over the past 12 months. Pepsi's revenue was hurt by subdued trends in the North America market. Volumes were down in the company's Frito-Lay and Quaker Foods segment in North America, and flat for its North American beverages business and Latin America segment. Volumes were higher in its other international markets.
Pepsi, like many packaged food companies, Tattoo Chef, has faced some challenges over the past year. Consumers are pulling back from spending because of inflation, while the rising popularity of weight loss drugs could further dampen appetite for snacks and soft drinks. Kramer said, "Oh, 'cause it's health trend. Oh, 'cause it's weight loss trend. Who wants vegan health food or snacks? Look at Beyond Meat stock. Give me a break. Could it simply because people are running out of money?"
This comes as the Federal Reserve holds interest rates high to combat the inflation monster. While wages have not kept up, thus leaving households with depleted personal savings and maxed out credit cards. This is exactly what I said would happen if inflation did not come down fast enough, and it hasn't. Households would not be able to keep up. They've drawn down their savings. Now more and more people are looking to save $1. They can't even afford Lay's chips anymore. Pepsi has previously said that shoppers in the U.S. have grown more cautious, snacking less, and making fewer purchases at the convenience stores.
The good news for investors are PepsiCo plans to raise its dividend by 5% later this year. The increased dividend will represent an annual yield of about 3.8% based on the price of $150, up from 3.6%. PepsiCo will keep its spot on a small roster of DK, Dividend King, those who has boosted their dividend annually at least half a century. Pepsi stock historically tend to outperform Buffett's Coke, so this is a huge buying opportunity.
What we're seeing now is a crystal clear message from consumers. Think about Tesla's double miss. This means folks are tapped out. Because the next thing is the ultimate, that is mass layoffs. Pepsi again signaling a massive warning for the economy that we could be right at the tipping point, and the evidence is clear. What am I doing? You know, as a long-term investor, this is the kind of opportunity I am waiting for. For so long I want to build out a nice Pepsi stock position because there's only one competition. It's either Pepsi or Coke. So I bought a lot of shares in Pepsi today. I know I don't even have to worry about the position even in an inflation or a recession crash because the moat is so wide. I believe right now the price of the PepsiCo business is actually undervalued for a wonderful company such as Pepsi. Gimme more. Bring it on, shorts. I can't get enough. Because for the rest of 2025, PepsiCo said it expects revenue to rise by a low single-digit percentage and a mid-single-digit percentage rise in EPS. In terms of Estée Lauder, it's only worth $25 billion today. She has lost over $100 billion in market value just in the past 3 years. I think they're on the right track. I believe the stock has bottomed, so what I did is I tripled my position in Estée Lauder stock, as I saw the insiders are net buying on the bottom low.
Jim, you want to do EL, right?
You know, there are stocks that are down today that are high quality. And then there's Estée Lauder. Now, this company was at 159 in February. Now it's at 68. They cut the dividend down 53%. They have a lack of visibility, getting a lot of downgrades. I want to be a little definitive. I wouldn't buy it.
Really?
Yeah. But this Estée Lauder, this was a premium company whose time has come and gone. Free cash flow last year, $9.5 billion, now less than $1 billion. Okay, let me say this about that. I made a mistake here. I was wrong. I trusted this management team. That was ill-advised.